This is a chart which is showing many investors are about to experience some extreme max pain in the markets. We've been covering this for many months, looking at many of these markets bottoming throughout this period of extreme talks of recession and depression. So in today's video, I want to have a look at how this could not end well for many investors who are banking on a possibility of a major crash in 2023. We've got the S&P to go through. We have the collapsing US dollar to continue covering here, as we have done for many months now, looking at this being the peak in September. The VIX, which is also falling, which is a great sign for the bulls, and why this is going to be an extreme painful time for many investors, like I said, in 2023.
That was a quick recap of what we've been talking about on the channel for over 5 months now. Now, if you recall, we've been looking at this since June lows of 2022, the October lows of 2022, and we find ourselves now in June of 2023. So far, we've seen some pretty dramatic upside action. Along the way, we've had some pretty dramatic scares in the market, the collapse of the banking sector, yet the price is now 12.5% higher for the S&P than where it was at the beginning of the year. So naturally, after so many months of upside movement in a macro sense, we need to expect or anticipate some sort of overhead resistance. Now, I'm not saying that we are about to collapse to a new low. We're not going into some sort of major panic, but we have to expect some sort of overhead resistance. We do have some levels coming up, and that's what I want to go through in today's video, looking at the S&P, looking at the little breakout here of the Russell, and of course the NASDAQ going on a mega skyrocketing run. And of course, we can't forget where Bitcoin currently sits at its $27,000 level, hovering at these levels right now, with the markets looking towards some resistance levels coming up. So stay tuned. Like up the channel with the white t-shirts. They've survived the last 5 months with a 2-year-old. Like and subscribe. You know what to do. Share the content with a friend, as we've been talking about this basing pattern coming in and a transitional stage into a macro bull market. We've been consistent on that for a very long time, with these prices now all the way back above where they were when the Russian war broke out as well. All right, guys, let's dive into the first piece of information. This week, we have a lot of high impact news announcements coming out. These little red things here on the Forex factory chart let us know what volatility is coming up. So for the Aussie market, at least, the main thing that we have coming up tomorrow is the cash rate. I know most people don't really care about Australia, but just a quick one for the Aussies. We're looking at 3.85, and they're not looking that, they're not expecting an increase in the interest rate. But if it happens, it happens. I think most people can expect that the US may, in fact, eventually go up as well. So I don't think it's going to give too much stress to the market. Nonetheless, 3.85 is where we currently sit, and that is where the forecast is this week for Australia in our high impact news announcements. As for the US, most people are looking towards next week's big data. So this is just a warning of where the narrative is going to shift now for the next 1 to 2 weeks. This is where the narrative will go. We know it's going to happen, so we have to anticipate that the market's probably already starting to price in these events. We can't be that stupid or naive to think that the market is just going to wait to see what happens. They have billions and billions and trillions of dollars on the line. They're not going to wait to see what happens. The volatility on the day, on the announcement, for a few hours there, is definitely going to be up, down, sideways, and great for traders. But big funds positioning themselves, they've got their models set up, ready to understand what they are looking forward to in terms of the announcements. So USD CPI is what's coming up next week. This is the big one. And then, of course, leading over to the federal funds rate. So basically the cash rate. The forecast is that it is going to stay as is. So at 5 to 5.25%. So they're not looking at an interest rate rise coming up in the next 2 weeks. So we've got to get through, like I said, the CPI data first. Most are expecting it's going to be relatively flat, and I don't think it's going to be too much of a scare to the market if it was to rise a little bit. We have seen that for some time, and we've been coming down for some time. So there typically is a reversal and potentially a further downside, or that is the reversal for a higher low to start forming and we head up into inflation again. Either way, I don't think now is the time to be getting fearful of it based on what the charts have been telling us for many, many months now, as I showed you in the intro as well. So the markets aren't anticipating any sort of rate rise. Maybe they get it, but they're anticipating one for July. So if it comes sooner, of course, that's going to shock the market short term, but they're still anticipating a rate rise nonetheless. Now, there's some huge warning signs of what is coming up next in the market. Before I get to that, obviously hit that like and subscribe button so you stay up to date with the content. As I've shown in the intro, there is plenty of content here that we've gone through to explain why the markets are doing what they do, how we're anticipating the macro movement in the market. And this, of course, is helping out many of you guys, and I'm seeing your comments. So thanks very much. And if you do want to stay up to date with those movements, make sure you check out the link in the top of the video description. We have our free crypto and economic report coming out this week. Emailed to you, just click that link right there. It will be met with a screen like this. Name and email, you'll get that delivered to you in about 48 hours time. All right, so now we come on to the big data, which was helping us identify the movements in the market, that 2023 was basically going to be a bullish year. Looking forward to this, looking forward to the markets rising up, to pumping. We looked at those lows in October on the channel. It's all there for you to go back and have a look. But like I said, most of us have got better things to do with our time. So let's have a look forward to these tough times ahead, looking at these resistance levels that we're anticipating the market to find some sort of issues at, some sort of resistance at before we continue to grind and start to pump higher. This has been one of those big indicators. What we're looking at here is the pre-election year. We have an election in the US coming up next year, 2024. Last year was the mid-term election year, and it was actually a bearish year. So these are some great signals for a bullish year in 2023. Remember, we were looking at the video that I just pointed out a second ago. That was the date of the 13th of January, and that is the signal right about here. So that's where it was at that video, about this section here. So the market is obviously up from that point. Same thing with Bitcoin, NASDAQ, etc. So the data was showing some pretty good solid returns all the way up. Start to plateau around May and June, a little bit of a push into July. So this is just a month and a week old. Looking at the purple line. The purple line is 2023, what's actually happened in the market. Now we can start to add to that. May was basically a bit of a churny sideways month. And then in the last week, we've had a push to the upside for the S&P. Remember, we're looking at the S&P here. So what's happened with pre-election years throughout history, going back to 1949, 70 plus years of data, all pre-election years is the black line. It goes up and up and up from January into July and starts to halt the market. We then have a churny August, a churny September, a down October. Remember what we've talked about, October is a great month for lows. Doesn't have to be the cycle low, doesn't have to be the all-time low, doesn't have to be the major significant low, but it is a good month for lows in the market. And we've covered this with approximately 100 years of data. So this is why I'm always suggesting to subscribe to the channel so you can stay up to date with that. All right, so October, potential low, a bit of a grind, and then we go up late November into December. So each of these data points show that the market continues up towards the later half of November into December. Some will call it a Christmas rally. Others will call it the 6 months after the sell in May and go away 6 months. So basically the Halloween effect. So the end of October. You can see here, this is October. This is the month of October. And the markets tend to churn up from there. So we know where we currently sit. This is May, just adding to this data here. And we've shot up to about 12%. Reason being, come across to this chart here. This is May, and now we've moved up. So I'm just measuring here. You can see there's 12%. There's your 12%, basically from the start of January. So that's where we currently sit. That brings us out to about 12% on this chart. So what's left in this move to the upside? Roughly speaking, we can see that there is potentially a move up to about 16%, which really is not that much more. And it's probably going to happen in June and potentially the first or so week in July. And then we basically stop. We head down for July, which will in fact potentially be a down month, because this is the start of the month, this is the end of the month, and of course within the month you're going to get that movement down, and then you got a down movement in August, you got an up movement here. So basically there's August, start and finish, so potentially a positive month, but there is going to be pain in August. Just looking at this, looking at history there. September, sideways again, maybe it ends out negative. October, not much happens start to finish, but you've got a pretty decent move to the upside and downside. And then November, same sort of thing before we start to get a move on. So this, although there's a lot of ups and downs, it doesn't look like it moves too much in terms of a percentage when you base it on the start of the year, that this 2023, looking at 12 to 16, basically that's the percent move from the start of the year. And this is going to be painful, very, very painful. This is going to churn people around. This is obviously is one of the possibilities. So far, the market has been moving relatively well to this particular event, besides the pretty big down move in February and March, which may lead this to springboard a little further to the upside and then cause more severe moves to the downside. So potentially more volatility within this zone. So we get higher highs, lower lows within that zone, not in terms of the cycle low or the cycle top, which then causes more pain because it basically churns up the trader, it churns up the investor, it churns up anyone who's trying to set their positions, because now we're adding volatility like we've seen earlier. It's adding basically a stopping point in the market. We're going to probably see some sort of resistance because we've already been up for the last 5 to 9 months from those cycle lows, and most people have missed out on that, talking about a bear market. Added to that, now they're trying to get in because they're all feeling a little bit more confident because the market is up. So what does the market do? It churns them up. It brings them in, it spits them out. It brings them in, it spits them out. It brings them in, it spits them out. And once we get rid of all those people, those investors, those traders, market is ready to push again. So stay very, very aware over the next 6 months, especially seeing as we've been up. We sure probably do have a little more upside to go, like we'll see in the charts in just a moment. But this next section of a period over summer and then leading into autumn is probably going to be quite churny, and you're going to see the bears come back. You're going to see the bulls get excited and the bears get excited, but probably a bit of a churn here because we've been up for quite some time. All in all, what I'm trying to do here is give a bit of a warning to these resistance levels for the S&P, for the NASDAQ, for Bitcoin, because we have seen a fair bit of upside. We've seen a lot of positivity. And of course, the bears are still sticking around, hoping for mega collapses. And we still see it in the comments section, which is absolutely fine. No hate against those guys whatsoever. But the markets have basically been on the side of the bull throughout this period. If you've been accumulating, getting into positions, now you have a lot of safety to the downside because the entry position is so much lower than where these bears are going to get in further up, or the late bull as well, as we just saw here. So this is going to be a bit of a churn. If you get in late and you see your position go against you by 10, 20%, that's pretty hard to hold on to. But if you were in during March getting those lows and you see the market go against you, you're still in a positive position. Not as much as you were at the peak, but you're still in a positive position. So what we're looking out for is around this peak here of August, 4,300 points for the SP 500. We got to see how the market reacts to that level and whether it slices through and then closes above those levels for flipping the resistance to support. That's good for the bulls. For the bears, you don't want to see, or what the bears want to see is a rejection and then a break back under 4150 and this yellow line right here. This has been those key levels. You can see it was held as support throughout April. So we're watching for 4,000. So we've got a couple of pretty key levels, pretty close to the downside here, 4,000, 4,050, and then 4,150. So bulls, again, break to the upside, hold, come back and test that next level around 4,550, which is that previous top, and the market has been rejected against there on the way down into that bear market low. Two key levels, 4,300, 4,550. That's what we're looking for the S&P. So for June, we also cover that on the channel. We're looking at pre-election year June here with the data points itself. Like you can see from this video right here that I did 5 days ago, May 30th, this is the forecast for June. And we're looking at it just being a bit of a churn, maybe a slight break to the upside, slight break to the downside, but we're probably not going to get too many massive moves on. I'd love that for Bitcoin, but probably for the S&P and the NASDAQ, maybe not too many massive moves based on what we're seeing right here over the next several months. And if we were to get them, there's still going to be a churn because we've been up for quite some time. So pre-election year, June since 1950, you've got the Dow Jones, the S&P, NASDAQ, and the Russell 2000 is what we want to have a look at. There's really nothing in it in terms of percentage to give us a clear direction. And the average move has only been 1, 1.5, 2.4, 1.9, and is basically split down the middle. So churny times ahead, pre-election years for June. And like we've noted before, June is also a great time for lows. That's probably why we're not going to get too big of a move to come and break any of these levels. Maybe. Let's see, because we have just started to break out of these levels, and that could be the area or the month that is the outlier and does give us that. Like I said, we have those levels to get past and what we need to see in order for it to happen. So June, pre-election years since 1950, not too much happens, churn happens, and then obviously the late bulls and some of those bears, which are late bulls, might get churned up. What we do see is the breadth starting to spread. People were worried, investors were worried that only a few stocks were holding up the market. Now, what we have here is the Russell 2000. Think of this as basically your shitcoins market for the stock market. It's a measure of the performance of about 2,000 of the smallest publicly traded companies in the US. So it's essentially the shitcoin market of the stock market. Like we talked about, if you have some of those stocks going up, the cream rising to the top first, and then skim off some of those profits, dump it into the shitcoins because you're hoping for bigger and bigger returns, because basically the biggest stocks or the bigger cryptos that you've invested in are probably coming to the end of their run. And we can see that across the S&P. We've got some resistance levels coming up, and we'll look at that for the NASDAQ as well. But now we see on the stock market, shitcoin market, a breakout. Look at this weekly chart. Top here, finally got that breakout end of last week, higher lows forming. And guess what? If you're following your Gann analysis with your 50% signals on your chart, look at that base form at 50%. This tells you that the bears have got nothing left and the bulls are going to win. It's just a matter of time. You had a low, slightly higher low, more lows forming at 50%. Market is starting to break those levels. Next key level is 2050, so 2,050 points. That's the next key level for the market to get above. Maybe it happens on this move. Maybe we just start to continue with higher and higher lows over the coming months while the rest of the market churns. Speaking of churn, we are nowhere near a churn for the NASDAQ, but eventually it will get to a churn. It has to. This is just what happens with these markets. We went through a churn in late March, April, and then the early part of May before we started to break out. So eventually this move will die, and maybe we go through another churn, which is all sort of lining up in terms of timing with the pre-election year through the mid parts, through quarter 3 into quarter 4 of that year. Going back to the NASDAQ, where could that happen? Somewhere around that 15,000 point level. We're at 14,500 now, so there's not far to go before we come up against some significant resistance that caused the market to dump from that point. Basically, the double top from the first major breakdown. So what happens from there? Probably the churn. The same thing, not to repeat myself, but if you do get a churn, there comes the late bulls because they're expecting further upside and they feel safer now because the market's broken out rather than buying closer to the lows, like I talked about on that first video there. And then we get them in and out before we can start to break again. So probably some more time there. What does that mean for Bitcoin? That's what everyone is here for, of course. I don't care about the rest of the market, but of course, Bitcoin. Well, we're still in our churny period and the market has basically been quite weak over the last few days. We closed underneath 27,167, so not a great sign for the bulls on the weekly chart here. But nonetheless, we're still holding up above those $25,800 levels. Now, what you can also see on the chart is the news events that have occurred during this consolidation period for Bitcoin. Whether it's a distribution or an accumulation is yet to be seen because we have not broken out of 31 or broken down from 26. So we don't know whether it's accumulation or distribution. However, these are the big news events that have happened through that period, and we still remain within that period. We had the debt ceiling crisis, which, surprise, surprise, no one talks about anymore, and that's exactly what we were talking about on the channel last week. We know what the market's going to do. They eventually figure out the debt ceiling crisis, and onwards and upwards we go within the same cycle. So for BTC, the key level is still that $27,200 or so dollars. You can see the support, the lows, the rejections, and now we're hovering right within that zone. So short-term Bitcoin needs to get above that so that we can continue on with this churny sideways period into the later part of quarter two, quarter three, and of course the later part of quarter three as well, as per the pre-election year pattern. Bitcoin's got a lot of work to do to get back into that bullish zone in preparation for a potential sideways churny market over this summer and autumn period. We've also got a lot of work to do ourselves, getting our economic and crypto report ready for you guys. So make sure you click that link at the top of the video description, subscribe to this. It'll be out in 48 hours. And I'll see you back here in probably less than 24 hours. Thanks once again for your support. Like, subscribe, comments down below. Question of the day is down there. I'll see you very, very soon. Until then, peace out.